Hi, welcome to Chapter 4. Here we're going to discuss long and short-term financial planning. Some of the learning goals today is going to be understanding the financial planning process, including long-term financial plans, short-term operational plans, understanding the taxable depreciation procedures that affect a firm's cash flow, discussing the statement of cash flow, operating cash flow, free cash flow, and discuss the cash planning process, preparation, evaluation, and use of the cash budget, as well as talking about evaluating the pro forma income statement, pro forma balance sheet, and approaches to the pro forma financial statement preparation and the common uses of the pro forma statements. Now, this is important because in the simulation we're playing in this class, the financial simulation, it produces pro forma financial statements at the end of each round. Some students think that these are fact. They are not facts, they're estimate. And we're going to show how that is created in this two-part lecture series on Chapter 4. Now, the financial planning process. Let's talk a little bit about this. Companies have to have some sort of financial plan, and it's a very collaborative plan where the team leaders from each of the areas of the company get together to discuss the inputs required to build a plan, the validity of the plan, how it meets the company's goals, the company's mission statement. And the two key aspects of the planning process are going to be cash planning and profit planning. So just like in the financial simulation, if you're working in a team, you need to come together as a group to make the decisions on where the company is going. What is your strategy? How is it going to be deployed? What's going to be how are you going to best use your cash, and how is that going to be converted into profit? You can see, even if you're playing this game in the solo in the practice, or you would see that each of the departments, they need to know what the other department is doing before they can work on their goals. So, if sales develops a product, they have to let marketing know this is the product, this is the features of it. Marketing has to set up a budget, and then sales and marketing work together, set up a forecast of how many units are going to be sold. So operations can decide upon how many factories will be employed, how many products will be built, and then finance needs to figure out a way if they can fund the capital budgets to fund all these investments and the manufacturing of all these products for sale. So everybody in the company has to communicate with one another and build a plan together that's going to, focus on where the company's going. Now, the cash planning is going to involve, companies putting together a cash budget. So this is something that managers use to figure out how much money do we have, what are our costs and expenses, and how much money should we go out to seek in financing. So if we don't generate enough cash internally in the company, additional cash has to be raised, generally through financing, looking for loans or selling bonds to help fill in the cash needs. Because not all businesses are going to have an abundance of cash at all times. Some businesses are seasonal, some businesses are less seasonal, but yet may have other demands, such as, once a year they have big tax payments, or once a year they have to buy an expensive piece of equipment. So planning for all of these eventual cash outlays is important for a company to maintain the cash liquidity. Think of cash as oil in the engine. So a company always needs cash, an excess amount of cash, to keep the company running, just like an engine always needs oil. Now, the financial planning process is going to begin with, a longer term, more strategic type of plan that helps to guide the formulation of what the short-term plan is for operating for the direction of the company. So the short-term implementation of the long-term objectives is what the managers are trying to do. So the long-term strategic plans are going to be a company's, where does the company see itself? Where are they trying to do? Are they a restaurant business that's trying to franchise from 10 locations to 1,000 locations? Are they an auto manufacturer that's trying to expand from the U.S. into North America, South America, and the rest of the world? What are they trying to do? And so they have to lay out these strategic plans that should be converted into financial actions to help get to their goals, get to their financial plan within anywhere from 2 to 10 years. So these plans have to reflect, have to be a reflection of what the company's strategies are. And, if they're going to compete in their market and they're going to create, maximize wealth for shareholders, then they're going to need some kind of plan that's going to integrate across the different functional areas: sales, marketing, production, operations, finance, human resources. And the plan is going to require input from all of these top leaders in the company in all areas of the firm to make sure that, do they have the research development capability to make a new product? Do they have the marketing expertise to, advertise and hit the right demographics to sell the product? Do they have the operational know-how to manufacture the product on a large scale? Do they have the human resources capable of hiring the people they need to support the product and either the direct manufacturing of the product or the indirect support of the product? Do they have the properly trained accounting personnel and finance personnel to help the financial managers to make a proper record of all the transactions occurring and make a proper financial plan as far as strategies to borrow and raise cash? Now, the magnitude and the timing of these actions really depends on the type of major investment the firm's going to take and how soon those investments need to be purchased. And they also have to constantly reassess the current investments and how they're paying off and how long will they last. So when you forecast the company's financial situations, all these have to be kept in mind. So these long-term plans are going to describe how a company is going to develop it, execute, and market its products to produce goods and services that are going to make the company money. And we're going to need to know, how many employees will the firm need to achieve these goals? How many, specific people do they have to hire with expertise in certain areas to make that product, market that product, build that product, create the proper financing environment to support the product. So these plans are very significant, and there is a certain amount of uncertainty and a certain amount of short-term hiccups that come up that could have more of a demand on cash that requires companies to have some sort of cash balance or cash surplus. Just like in the financial simulation we're using with this class, you have a $25 million cash minimum balance you must keep, but then any cash above that is sort of a surplus. And if your company runs out of cash, you end the year without having a cash deficit, that's going to be very bad for the way people look at the planning and functionality of the company. That's why you lose so many points when you have these unexpected cash deficits by making forecasts or decisions within the company that are costing the company a lot of cash and not generating any cash flow or profits. So these long-term, influences are going to be very important to investors and investment in financial decisions. So a series of budgets have to be created to support and demonstrate how these long-term goals are going to be supported. Now, the shorter-term financial plans, here we're looking at a smaller time frame. Now we're looking at, we'll say a year or less. So we're looking at, the short-term financial plans, what I would describe as, 12 months or less. And hopefully these short-term plans are going to have some effect over the company reaching for a couple of years. But the key inputs are going to be the sales forecasts, the operating budget, and the financial data needed to measure the success of these short-term plans. So the outputs are, of course, going to be operating budgets, cash budget, pro forma financial statements. These are all things that are going to help with the short-term financial planning process. So this chapter is going to focus on a lot of those tools that you can see in this chapter and we'll work with through Excel. And you can see it happening in the simulation as well. When you're playing the simulation and, the decisions you're making, if you make some bad decisions in a year, you could wind up, costing your company a significant amount of lost sales or profits based on poor execution of your strategy. Now, let's go to a personal financial example. So in your personal financial plan, this is going to require you to define your goals. Whereas a corporation, the goal is to maximize shareholders' wealth, but typically you might have several different goals for yourself, and they might be some short-term, long-term goals, depending on your age, your income, your family status. So in your own personal life, you may look at your financial plan as this semester. So do I have enough money to pay for the tuition, my portion of the tuition this semester? Have I lined up my student loans or my scholarships? And do I have enough money to live on from week to week to support myself for, meals, food, entertainment, travel, or commuting to and from school, different things like this. So you might have the short-term horizon or even the medium-term horizon of how are you going to pay for and finish school within, say, typically 4 years. And then your longer-term horizon would be, why are you going to school? It's not really for a short-term goal. It's for the long-term goal of getting a better-paying job that's going to result into a stronger career where you're going to earn more money than if you didn't have a bachelor's degree in business. So these are just sort of, you have your own personal financial plans. You may have not really done much to quantify them, put them down on paper, but that might be something you might want to look at, especially when you're accumulating these student loans. You might want to take a closer look to see, okay, is there anything I can do to minimize the amount of loans that I'm taking? Meaning, can you get more scholarships? Can you work a part-time job in the summer? Can you figure out a way to reduce your tuition? I remember one student telling me that they were taking extra classes so they could graduate a semester early and save a semester's worth of tuition, which is, okay, not a bad idea, right? But there's a sacrifice. If you're not somebody who can deal with the extra class load and affects your overall learning or your grades, it might not be smart to accelerate your graduation. So there's a give and a take. Okay. So we're going to go into measuring the firm's cash flow. Now, so let's just kind of recap a little bit. When you are making a short-term financial plans, of course, key things to remember before we move into this cash flow part of the lecture is developing a sales forecast. So this you're having practice with in the simulation, but companies have to, and we'll talk more about this in this chapter later, developing a sales forecast that's going to lead to a production plan, that's going to lead to selling the products and making profits. So that's all well and good, but if you run out of cash during any of those steps, your company is what we'd say insolvent or possibly bankrupt. So that's why it's important to figure out how to measure your cash flow. Now, remember that cash is king in finance. Cash is the blood of companies, the oil and the engine of companies. So cash flow is, the main thing that we're focusing on in any financial valuation model is cash flow. So we don't necessarily look at profits, and I'll explain why in a few minutes why we're not so concerned about profits. We're really concerned about cash flow. So if a financial analyst wants to put a value on a company, they're going to estimate the cash flow of that company in the valuation process, and they're going to value the company as a multiple of annual cash flow, not profits, because cash flow is a truer, more precise number than profits because of the non-cash charges. Now, so a company's earnings, they receive a lot of attention, of course. Earnings per share, investors, they look at earnings of a company and cash flow, but earnings and cash flow are not equal. So when companies calculate their earnings, they are adopting accounting practices that are accrual based, and their principle is designed to achieve the objective for reporting profits. Now, if a company pays cash today for an asset they're going to use for many years, like a piece of equipment, the accounting principles generally don't permit the firm to deduct the entire cost of the asset as an expense against earnings that year. Rather, the firm has to spread it out through a number of years, which is recognizing that the asset's going to lose value year after year. Just like if you buy a new car, that if, say, you buy a new car for $30,000, 3 years from now, the car's not going to be worth $30,000. So accounting in companies, we need to record the as assets devalue throughout time. Now, in the accounting principles, we reflect the view of these, charging small expenses over an asset's life. That's going to represent the financial performance, and then deduct the asset's entire cost from, the earnings of that year that the firm purchases the asset. Now, the allocation, which is like a historical cost over time, is what we call depreciation. Now, tax laws do change, and sometimes you can depreciate the full asset in 1 year. But most of the time, most of recorded time in accounting, depreciation is a methodology for recording the devaluation of an asset over many years. Now, when a company does deduct this depreciation expense from income, this is an accounting rule. It's not a cash outflow. So basically, we're allowed to reduce our income by the amount of depreciation for that asset that year, which reduces our income. But it's considered a non-cash charge. So no one writes a check for depreciation expense. Just like when your car, you roll it off, it's a new car and you bring it home after 3 months, the car lost $3,000 worth of value. You didn't write a check for $3,000 to anybody to reflect the $3,000 you lost in the devaluation of your car over time. And it's the same thing with companies. They're not writing a check. The only reason that the depreciation is deducted is to influence the cash flow, is to reduce the taxes. And so if you're able to reduce your income, then you're reducing your taxes, and then your company's paying less taxes, then it's more profitable. So, but when we're calculating cash flow, we have to bring back that depreciation back into the cash flow because it's a non-cash charge. So let me just sum this up again for you really quickly. When companies buy assets, they're allowed to reflect the devaluation of those assets against their income. So if their buildings, trucks, computers, plants, and equipment are reduced in values for some reason, there are accounting rules on how much of that we can deduct from our income each year. As we deduct it from our income becomes smaller, our tax burden becomes smaller. But when we calculate cash flow later on, we want to add back the depreciation into the cash flow because it's a non-cash charge. We used it only to reduce the income, to reduce our taxes, but if we're looking at the true cash flow of the company, we add it back in. Now, as far as U.S. taxes are concerned, there are different depreciation methods how they can be applied on tax returns. So a firm many times gets to choose. So the reason many firms, keep two separate sets of books, one is for taxes and one's for public financial reporting. So depreciation affects cash flow only to the extent that it influences taxes. So depreciation method we want to use the depreciation method that's going to get us the most taxes back the soonest. So when we're trying to measure cash flow, it's going to it really distorts income to reduce taxes, but we need to add it back into our cash flow to reflect the fact that cash really didn't go anywhere. And if you don't understand that concept, just keep thinking about the car you bought for $30,000 that now is worth $20,000. Did you actually send out $10,000 to anybody to represent the fact the car is worth less today? No, you didn't. So it didn't affect, when the car loses value, it's not affecting the cash in your bank account. It's just affecting, the amount of cash you would generate if you resold the car at a later date. Now, because companies want to save on taxes, because that's going to ultimately boost their cash flow. Now, one thing to remember, that there was a big Tax Cut and Jobs Act of 2017 that required depreciation for most types of assets, to use the modified accelerated cost recovery system. But the new law allows, but does not require, firms to immediately deduct 100% of many different types of assets. So this is something a company can choose. So it's sort of like a bonus depreciation or an enhanced depreciation to allow companies to more quickly or fully deduct their assets in the year that they buy them, even though the asset may have multiple years of a useful life. Why did they do this in this 2017 Tax Cuts and Jobs Act? Well, they did this because they wanted companies to have lower their overall tax burden and give them more profits that they could use theoretically to expand their business, grow the economy, and hire more people. Now, studies will probably be done to see if that was if that actually turns out to be the effect of that. And yes, some companies probably just pocketed the money, bought back stock, or returned it to dividends to investors. And some companies may have used it to expand operations, hire more people. On aggregate, it would be interesting to see if that, net, if that was the overall increased outcome of employment. I don't know for sure. Now, if we look at the depreciable value of an asset, so under the what we call, you see the acronym here, I was right here, MACRS, and that's the Modified Accelerated Cost Recovery System. This is the system that most companies like to use. And prior to the 2017, most firms were required to depreciate most types of assets using this modified cost recovery schedule. Now, companies can still use this modified accelerated cost recovery schedule if they choose to. And this bonus depreciation of 100% deductible is going to be phased out over time. So we'll be back to the point where everyone's using the modified accelerated cost recovery schedule for all the assets. Now, this depreciation method is a law that's created to guide companies in how to depreciate assets. And it's something that the IRS will provide guidelines for, outlines for, on how to depreciate an asset. Okay. So what's the depreciable value of an asset? So there's a procedure that we're going to go over in a few minutes that for each particular asset class, there's a value of the asset at full cost, including outlays for installation. So it's not just what you pay for the asset, it's also any installation costs that you might put into the asset. So let's go over an example here. But remember, prior to an asset being depreciated, it's going to, we're going to have to figure out what the depreciable life is. And that's each particular asset has a different lifespan. Just like, you might say a car would last for 10 years, a computer could last for 5 years. So the larger the annual depreciation deduction, is going to be, the shorter amount of years you have to fully depreciate, the larger your annual depreciation is going to be. Now, when we do the modified accelerated cost recovery schedule, typically most assets are going to either fall in the 3, 5, 7, or 10 year pattern. So let's look at this. Here's an example. A new machine costs $38,000 and the installation cost of $2,000. When the machine is retired from services, they think they could sell it for $1,000. So regardless of what the expected scrap value is at this point, the depreciation value of the machine is going to be $40,000 because you're going to add the depreciation into it. Now, we know that a number of assets can be depreciated at 100% of the cost the year it's purchased. Although not all types are eligible for this 100% instant depreciation, some assets are still going to have to be modified accelerated cost recovery schedule. Now, there are a couple of different depreciation methods that companies can use, such as straight line, double declining balance, the sum of the year's digits. These are all other possible depreciation methods. So companies can choose what depreciation methods fit them best. But for tax purposes and financial purposes, most companies will choose to depreciate under the modified accelerated cost recovery schedule, property classes, because that is what's going to accelerate the depreciation the fastest. It's the depreciation method that you can depreciate the quickest with. Now, companies can, switch back and forth, but they have to have a rationale and consistency when they're moving between depreciation schedules. Here is the typical 3, 5, 7, and 10 years, and they give this definition. Some certain tools and equipment are 3 years: computers, printers, copiers, technology equipment, usually 5 years; furniture, fixtures, equipment, railroad track, 7 years; and then petroleum, refining, manufacturing, and tobacco products. These are just some examples of different asset classes, and the IRS will provide a more detailed list of what assets fall under what recovery period. So how it's laid out is, if you have a 3-year recovery period, your assets actually broken up into 4 different depreciation years, because the first year and the last year are considered 6 months. So rather than trying to prorate your purchase at any point of the year, they just assume that you own the asset for the first 6 months of year 1 and you own the asset for the last 6 months of the last year. So in the 3-year, it's going to be 4 years which you can deduct the asset over. So for every period, 5, 7, 10, there's 6 periods, 8 periods, and 11 periods of deductibility. Each of these represent a percentage, and all these percentages added together will be 100% of the asset. So if you add any of these columns together, it's all going to equal 100%. It's just a different percentage level of the asset that gets deducted each year. So if we have that cost of the asset for $40,000, okay, so when we lay this out, the depreciation base is going to be $40,000 every year. That never changes. A lot of students have this intuition where if I depreciated $8,000 last year, year 2 should start off at $32,000. No, you don't deduct the value of the initial asset. It always stays at $40,000, and you multiply your percentage against that $40,000 each year, as you see here. $40,000 times each of the percentages. By the time in the last period, if you add all your depreciations together, you get the full cost of the asset. And each year, this is going to be a deduction from your income, reducing your taxes, increasing your profits. And that's why companies like to depreciate. Now, and you'll see how this depreciation is going to fit into the statement of cash flow, because we're going to have to add this back later. The depreciation is an expense we list out on the income statement under the operational investments. Operational portion of the income statement to reduce income before we pay tax. Now, a very critical financial statement that we want to look at is the statement of cash flows. So in this statement, we're going to look at cash, and we're looking at the direction of cash. Is it coming into or out of the company? And we can break this up into 3 distinct areas. We have cash that comes from the business activities, which we call cash flow from operating activities. And then we have cash flow from investment activities. So this would be cash generated from different investments the company makes. And then there'd be cash flow from financing activities. This is money that the company can raise by issuing bonds, taking on loans. So all 3 activities, operations, investments, and financing, are ways to bring cash into or out of the company. And we want to break this up and get a better idea of where a company is getting its cash flow from. Because you want the cash flow, ideally you would want the cash flow to come from the operations of the business, not from borrowing. So, if you had, if you're looking at two different people and both people look equally wealthy, they both drive new cars, they both have nice clothes, they both have nice jewelry, and they both spend generously on lunches and dinners, eating out and going on vacations. So they would look, both to the naked eye, they would look like they're both successful and wealthy. Then you find out one person pays for all of their expenses and assets through the money they earn at their job or money they make on their investment portfolio, while the second person finances everything on credit cards and personal loans and refinancing their mortgages. So who is really wealthy now? It's definitely the person who are paying for their activities with cash generated from their investments and their operating or work activities, rather than the person financing everything through debt. So that's why analysts will look at the companies. They want to see, is the cash flow being financed through debt, or is the cash flow being financed through the operations of the business? So if you look at a business like Netflix, a significant amount of the cash is being generated in the past has been generated through selling stock or selling corporate bonds or borrowing money to fund their multi-billion-dollar investments in new content. So that, to me, makes the company a little bit riskier, because the cash flow the company generates isn't the significant portion of the cash that they're spending. Most of it's coming from selling equity in the company or issuing bonds, which is an investment that, like Amazon, if it pays off in the long term, the company could become very profitable later on. But sometimes, and just like in a simulation, you may have to borrow in the initial first couple of years of the business to get the business to the scale and size you want the business to grow to. And then later on, in later years, as the business is self-funding and generates enough cash flow to pay for any investments and also enough cash flow to pay down debt. That's what we like to see in a business. They actually get to a point where they can pay their debt down. Now, when we develop a statement of cash flow, it's key to understand the cash inflows and outflows. Now, this can be quite confusing, because don't try to think of a company's cash flow like your personal cash flow, because the company is running on a set of accounts, a chart of accounts that are unlike and not completely treated the same way as you would treat your money in your life. But by and large, the cash flow statement is simply trying to group the inflows and outflows of cash into these three categories that I had mentioned in the previous slide. And we want to know, as we're constructing this cash flow statement, we're going to need information from the income statement and the balance sheet. And the changes in these statements are going to represent the cash inflows and outflows of the company. So when a firm earns a positive net income, this is going to count as a cash inflow. But what you may not really understand is that a company's income statement shows a deduction of depreciation expense that is also a cash inflow. So remember that the depreciation expense that we took on the income statement that we talked about earlier, this is designed to kind of smooth out the reporting of the costs of an asset over time. So when the firm deducts that depreciation on the income statement, there's really no cash being paid to anybody. There's no cash being taken away from the company. So that fact alone, you need to understand that a firm's net income is going to be less than the actual cash flow. Cash flow is generally larger because we're going to add back that depreciation expense to the cash flow statement. Now, changes in different accounts on the balance sheet is going to affect the firm's inflows and outflows of cash. So when you increase an asset on the balance sheet, this is going to represent a cash outflow, because when you're buying inventory, you need cash to buy the inventory. So if inventory is an asset and you're increasing the asset, it's going to consume cash. So when the firm buys new assets, cash is going to go down. Cash flow is going to go down. Now, if a firm reports higher fixed assets, like this plant, building, equipment, from one year to the next, that means there's a cash outflow is tied to the acquisition of these new assets. And the same is true for, inventory, accounts receivable, even the cash account. When you see the cash account, don't think of that as cash flow. Think of that as a cash account. Think of cash flow as a pile of cash that you have on the side that's growing and shrinking as the balance sheet's changing. If you decide to put more of that cash into a cash account, then the overall cash flow would shrink. If you decide to take money out of that cash account, your cash flow will expand. And this is generally the point where students have a hard time understanding that. But just, a cash balance, a cash account is an asset. So if it increases or decreases, it's going to affect your cash flow. Think of it like this. If you had cash in your pocket, $2,000 in your pocket, and that's your cash flow, the money in your pocket, and you take $500 of that and put it into a savings account, your savings account, your cash account grows in the bank, but your cash flow in your pocket shrinks. So just remember that it's a little bit different for liabilities. So if the liability account gets bigger, that's a cash inflow because you're borrowing. So if you have a loan account and you borrow $100,000 and your loan account increases, that money is going to go into your cash flow. So you just have to remember that a cash inflow is a decrease in the asset or an increase in the liability, any net profits the company makes after taxes, or depreciation of other non-cash charges would be considered a cash inflow, as well as the sale of new stock. Cash outflows would be increasing an asset. So if you increase your inventory, you're going to use your cash flow to buy that new inventory. A decrease in liability. So if you have a loan account and you decide to pay back that loan, it's going to decrease your cash flow or become a cash outflow. Any net losses are a cash outflow. Any dividends paid are a cash outflow. Any repurchase of stock is a cash outflow. So just to make a few clarifications on this, a decrease to any asset, even the cash balance account, is going to be inflow of cash. And this is because funds that are tied up in an asset are released or used for some other purpose, such as repaying a loan, or and this is what we would call increasing our cash flow. But remember, if you increase an asset, this is going to decrease cash flow or because the outflow of cash. So increasing any asset would decrease cash flow because as you're buying additional inventory, you need cash to be purchased, or you buying additional fixed assets, this is going to consume cash. So remember, increasing of an asset is going to decrease cash. Now, when you think of a liability, if you're going to increase a liability, that means you're borrowing money, generally. Increase accounts payable, increase long-term debt. You're borrowing money that's going to increase to your cash pile. And whenever you decrease a liability, that means pay back a loan or pay back a credit card, you're going to decrease your cash, or it's going to be becoming a cash outflow. So with liabilities, it's a little easier. Increase the liability, increase cash flow. Decrease the liability, decrease cash flow. So it's easier, kind of a little more straightforward that way. And this is basically what I was just saying before. Inflows, decrease in asset, increase the liability. Net profits, depreciation, or the sale of stock. Cash outflows, increase in the asset, decrease in liability, net loss, dividends paid, or repurchase of stock. Now, if we're going to develop a statement of cash flow, we have to classify these flows of cash, these inflows and outflows of cash. Now, we got to remember that depreciation and amortization are non-cash charges. Depreciation is the deduction in value of a tangible asset like a car. Amortization is a depreciation of a non-tangible asset like a cartoon character or a brand. Now, so what is a non-cash charge? It's an expense that we deduct from the income statement, but doesn't involve actually spending any cash. So depreciation is the biggest example of this that we're going to work with in this chapter. So if we're going to accurately reflect the cash flow, we have to add back this depreciation expense since it really wasn't an outflow of cash like you might think on the income statement. Now, only changes in gross net fixed assets appear on the statement of cash flow. And that's because we want to net them. So if you see them on a balance sheet, we're gonna get what we would list out the fixed assets, and then we would say less accumulated depreciation to get the net fixed assets. And we do that because we don't want to reflect the depreciation twice. So that's why we say net fixed assets is what's going to appear in the cash flow statement, because we want to make sure that we don't count depreciation twice. Now, also direct entries or changes in retail earnings, retained earnings are not included in the statement of cash flow. These retained earnings get their own statement that we'll talk about later. Okay, so if we're going to prepare a cash flow statement, we need to look at all the cash inflows as well as net profit after taxes and depreciation. These are all going to be treated as positive values. All cash outflows, any losses, any dividends paid, are going to be treated as negative values. So here's an example of a cash flow statement. Now you can see here are the sales. This is the income statement. So here's the example of income statement we're going to be working with. Here is the from the sales to the gross profits. Here's a depreciation expense of 100, our total operating expenses, and then all the way down to our net income before taxes and our net income after taxes. So we're pretty familiar with, we're going to be using some information from this income statement, and then we have our balance sheet here, and we see what's important here is that this less accumulated depreciation. See, we went from $1,200 to $1,300. There's a $100 difference here. That's what is being recorded. Depreciation is being recorded this year. So that's why it's up $100. But we're going to subtract it out of the fixed assets to represent the net fixed assets. And you'll see that. And what's important is the change in the accounts when we go from one year to the next. So accounts receivable decreased. Inventory decreased from 900 to 600. That's going to be, this is an increase of cash flow of 100 and an increase of cash flow of 300 because these assets were reduced. So we get down to all the way to the second half. This is liability and earnings equity of the balance sheet. Now we get to the cash flow statement. So here we're looking for cash flow from operating activities. So remember I said here's our decrease in inventory of 300, our decrease in accounts receivable, increase in accounts payable. So these are all going to be cash inflows, as well as the net taxes after profits. So if we look back up here, this 237 is our net taxes after profits, and that gets carried into the first part of the cash flow from operations. So we're looking at the changes in these balance sheet accounts, and we add these together, and we get the operating activities increased cash by 837. Now, if we look at from the increase in gross fixed assets, we have a negative 300. So again, we go to the balance sheet, we see our gross fixed assets here went from 2,200 to 2,500. That's an increase of 300. And what that means for our cash flow is that we spend an extra 300 on these gross fixed assets. So that's a reduction of cash by 300. Change in equity investments, no change. So we have cash provided by investment activities, net negative 300. So we made $300 worth of investments in our gross fixed assets at this time. So when we look at our cash flow from finance activities, we had a decrease in notes payable, increase in long-term debt, zero change in stock equity, and dividends paid. Cash provided by financing activities is only 20. So it's the negative 100, negative 80, 200 leaves us a positive 20. So the net increase in marketable securities is going to be here 557. Where does this 557 come from? If you come up here, we're going to take our 800, add in the negative 300, brings us to 537. And then if we factor in the 20, that brings us to 557. So this is the net balance of financing, operating, and investing activities. I just want to clarify something. I was talking earlier about, let's go back up to the balance sheet. I just want to state this. I might have mixed it up before. But the net fixed assets here includes depreciation. So we don't want to use that. We want to use the total gross fixed assets, the change in the total gross fixed assets here when we do the cash flow statement, change in investing activities. And because depreciation is treated as a separate cash inflow, if we go back here, this is where we're treating it as a separate cash inflow. Only changes in gross rather than the net fixed assets are going to appear in the statement of cash flows. So it's the change in the net fixed assets is equal to the change in the gross fixed assets minus the depreciation charge. So therefore, if we were treating depreciation as a cash inflow up here on this line, as well as a reduction in net rather than gross fixed assets, we would be double counting the depreciation. So in order not to double count the depreciation, we count the depreciation as a cash inflow here, and then we're going to count the increase in gross fixed assets down here. So when we go to the income statement of the income statement up here, we're going to reflect that $100 of depreciation expense here, which increased our expenses. But we're also going to further on in the balance sheet, we're going to ignore this accumulation here, which would be reflected in the net fixed assets. We're going to just only focus on the gross, which is the $300 difference. So on the cash flow statement, you see the $100 increase here in depreciation, and you see the $300 reduction here in gross fixed assets. Add the three sections together. Here, the 837, the negative 300, and the 20, and we get the net cash flow, which is 557. Okay. I'm going to stop here, and in the next half of this presentation, I'll talk about interpreting the cash flows.